Everyone wishes to become wealthy ASAP. However, if investors have a good game plan, they can make a fortune. In this video, we will show you how to avoid the common pitfalls of investing in today's stock market. The wealth of advice contained in this video will benefit both serious and first-time investors. Before we get into the video, don't forget to drop a like on this video and subscribe to the channel if you haven't already. Make sure that the post notifications are turned on so that you never miss a video from us. Without further ado, let's dive in. 10. Becoming emotional about stock. Never get too worked up about stock. It distorts judgment. This quote from the fictional character Gordon Gekko in the film Wall Street is well known to most stock investors. While the film takes liberties with how the stock market actually worked in the 1980s, this quote remains a Wall Street truism. Fear and greed are the two most powerful emotions in stock trading, and too much of either can be disastrous. Fear of losing more money causes many investors to exit their positions just as they recover, whereas greed for more profits, along with its sister, fear of missing out, causes other investors to chase high-flying investments as if they were playing in a casino. Keeping a level head in times of panic and euphoria can help you avoid making bad investment decisions at the worst possible times. 9. Overtrading. While the elimination of trading commissions on stocks and ETFs have undoubtedly benefited investors, it is not without drawbacks. Some investors may overtrade because they do not have to pay anything to buy or sell stock. Buying and selling securities frequently not only exposes you to tax consequences, but also has a negative impact on long-term returns. The bottom line is that most investors aren't great stock traders, and the more frequent you trade, the more likely you'll come up short. We'll link periods of intense buying by retail investors at the brokerage Robinhood to future negative returns, writes Brad Barber, a professor at the University of California, Davis, in a paper co-authored with him. While Robinhood isn't the only source of overtrading, it is where many active traders live, and their frequent trading often leads to underperformance. 8. Investing without a written strategy. It's easy to mistake investing for gambling, but the stock market's long-term returns are fairly consistent. In fact, there has never been a 20-year rolling period in stock market history when the S&P 500 returned a loss, and the S&P 500's long-term average annual return has been 10.5%. That will more than double your money in less than 7 years. To achieve those kinds of consistent returns, you'll need to devise and stick to an investment strategy. A written investment strategy can help you avoid investing based on emotions. Everyone wants to be in the market when it is making new highs, but no one wants to buy it when it is making new lows. If you follow your written investment strategy, you can avoid making rash investment decisions and instead stay on track for long-term financial success. 7. Putting all your eggs in one basket. One of the cardinal sins of successful long-term investing is a failure to diversify. Each additional investment type and financial market you choose for your hard-earned money functions as its own basket. This enables you to be more strategic about how you invest your money. Why choose just one risk level when you can choose several? Combining higher risk investments such as stocks with lower risk investments such as bonds, and combining emerging markets with more established ones allows you to maximize potential returns while limiting overall losses. Diversification is the best strategy for most investors. So instead of just one basket, you'll need a cabinet full of them. Buy a mix of stocks and commodities for higher potential growth and bonds and real estate for stability. To avoid becoming overly focused on a single region or market, aim for the investing equivalent of a round-the-world trip, visiting as many global destinations as possible. If you don't feel comfortable making decisions on your own, a digital wealth management service can handle everything for you. 6. Avoiding real estate. Millionaires have assets. They diversify their holdings. They invest in tangible assets such as real estate, which can generate income and increase in value over time. By the way, a tangible asset is simply something you own that has a physical form. Everything from land to gold bullion to your cousin's beat-up used Honda Accord is covered. Diversifying your assets is a risk management strategy because the value of tangible goods is independent of the fluctuating value of the stock market. The key is not to put all of your eggs in one basket. Real estate ownership has numerous advantages. Real estate investing can be started with as little as $500. Your money is invested in private real estate across the United States through their Fundrise Starter portfolio. The company handles all of the heavy liftings. Real estate can be included as a diversification tool in a diversified portfolio of stocks and bonds. Many wealthy people own physical real estate for income, future appreciation, and tax advantages. 5. Chasing performance. Pursuing performance has always been a risky investment strategy, but it could be even riskier in 2022. Cryptocurrency and meme stocks were the most popular high flyers in 2021, with gains ranging from 1,183% for AMC Entertainment to a staggering 43 million% for Shiba Inu. Investing in speculative winners like that almost always results in disaster for the average investor. To begin with, you must assume that others will continue to buy and drive the price even higher. But deciding when to sell is even more difficult. Investments with skyrocketing performance can easily turn around and drop 50% or more, leaving the question of whether to add more or sell. It can be difficult to know. If you must take a chance on these types of investments, keep them to a small percentage of your overall portfolio. 4. Trading at a high-cost broker. There will be no need to trade through a high-cost broker in 2022. While paying for specialized financial services such as estate planning or wealth preservation may be worthwhile for some people, there is no reason to pay for stock and ETF trades. Aside from the countless online brokers such as Robinhood and SoFi that allow you to trade stocks for free, many old schools, well-known brokers such as Schwab and Fidelity, as well as Merrill Lynch and Chase Bank, now offer zero commission trading. Paying to execute your day-to-day investment transactions will unnecessarily reduce your investment returns in this type of environment. 3. Failing to rebalance. Balancing your portfolio entails creating a portfolio that is tailored to your specific risk tolerance and investment objectives. But simply setting it and forgetting it isn't enough. You must also ensure that your portfolio remains balanced, which is known as rebalancing. The goal of portfolio balancing is to achieve the desired proportions of risk and return potential in your investment portfolio. Allocating your assets occurs when you first design and commit funds to an investment strategy. As an example, you might want to invest 70% of your portfolio in stocks and 30% in bonds. When you first fund your portfolio in this manner, you have what is known as a balanced portfolio. The issue is that these allocations in your portfolio do not remain constant over time. Assume the stock market's value doubles in 5 years, while the bond market's value grows, but not nearly as much. The value of your portfolio's stocks would become much greater than the value of your portfolio's bonds, throwing your investment portfolio significantly out of balance. To maintain a balanced portfolio over time, you can and should rebalance your investment account. If your initial risk tolerance led you to invest 70% of your money in stocks, your rebalanced portfolio should be 70% stocks again. 2. Overreacting to a market sell-off. If you are a stock market investor, you should be aware that corrections or sell-offs of at least 10% are unavoidable. Stock market corrections have happened on average every 19 months since 1928. It had been nearly 2 years since the market had experienced a 10% or greater decline, with the most recent being a 34% drop in March 2020 due to a pandemic. Ever since, the market has risen almost straight up, prompting many analysts to predict a market correction. However, you should not be alarmed if the correction occurs. Many investors underperform the market because they sell when the market is down and things appear bleakest. People who ride out corrections, on the other hand, have consistently seen the market race to new highs. 1. Putting all your money into crypto. Even if you're a cautious investor, you can't ignore the recent buzz surrounding cryptocurrency. The financial news is dominated by reports of unfathomable gains in the crypto sector, with unusually named tokens like Shiba Inu posting returns of 42 million% in 2021 alone. When investors looking for a quick buck hear about these types of returns, they are understandably drawn to cryptocurrency. Although there is nothing wrong with investing the speculative portion of your portfolio in cryptocurrency, but putting your entire nest egg there, or into any single investment for that matter, is courting ridiculously high levels of risk. If multi-millionaire fund managers like John Paulson predict that cryptocurrencies will eventually go to zero, you should be wary of investing too much of your money in them. With this, we have come to an end. The content in this video is for educational purposes only, and hence should not be considered financial advice. All the financial decisions should be made after doing your wide spectrum research. Do let us know in the comment section below. Also, make sure that you like this video, and also do not forget to subscribe to our channel to stay updated about the latest videos. Until then.